Welcome in, folks. It's a six-piece here today, a six-piece chicken to react to. So first video up here, Nvidia earnings may have bigger impact than usual on the markets. Nvidia reports around 24 hours from now. And so I think it's very important we cover Nvidia here at the top. I'll share my opinions and perspectives, what I think is going to happen here with Nvidia stock. Nvidia's underlying demand is very good and execution is strong. We'll react to that one. And then this Nvidia video, markets and AI can continue to roll on without Nvidia. That's a big take there. So yeah, the first three videos will really be focused on Nvidia. Then we're gonna get into this one. Dan Ives went on CNBC, spoke about the Apple CFO transition and a few other things this morning. So I want to react to that one. It's still time for investors to focus on quality, says Gabriela Santos of JP Morgan Asset Management. So looking forward to reacting to that one. We'll speak about kind of, let's call it focusing on quality in the market and what is really quality in the market. Expect the Fed to cut a series of 25 basis point moves, says Roger Ferguson. So he was a former Federal Reserve vice chairman. So if there's a person that's very knowledgeable on how much the Fed's going to be cutting here moving forward, I think it's him. So I'm looking forward to reacting to that one, sharing my opinions and perspectives. Appreciate y'all joining me as always. Thank you so much for being here. We're on the path to 50,000 subscribers here on the channel. I appreciate each and every person that is subscribed here to the channel. And let's go ahead and let's start diving into this.
Mixed with the Dow pulling back from its record high set just yesterday. But our next guest believes strong earnings growth will drive stocks even higher from here. Joining me now to discuss this is Andres Garcia Amaya, the founder and CEO of Zoe Financial. Andres, thank you very much for being here, especially in person. We love having you in studio. Let's talk about this back half of the earnings season. All of the big names are done except for one very important one. Some would argue the most important one of the entire season, and it's not Alphabet or Microsoft. What do we think about Nvidia and the impact it's going to have tomorrow?
Regardless of what the results are, what's important to note is that if you look at the options, they're pricing a move up of 10% or a move down of 10% for a stock that's now 6% of the S&P 500. So regardless of what your view is, it matters for macro. And even 2 years ago, it was less than 2% of the S&P 500. So it is the show, especially in August at a time where it's quiet. It could even have a bigger impact than usual.
Do you think it's, from a market perspective, because...
So the market's expecting Nvidia to basically move up or down 10% plus. What's my opinion there, right? My opinion is unless there's some sort of shockingly bad or good number, I actually think the move's going to be very muted the next day. I'm thinking like 5 to 7%, maybe 4. Actually, I would go kind of more in the range of 4 to 7%, which could shock people because everybody's expecting this massive, either crash in the stock or flying high, right? That's what everybody's expecting. But my thought process is unless there's something so great or something so horrible in that earnings report, I think it's going to be a super muted move. I'm talking 4 to 7% the next day. We'll see where it all shakes out. But that's honestly what I'm expecting. So I think everybody's expecting fireworks, and I don't know if we're going to actually get fireworks in this report. It could just be a very good earnings report with a very good guidance and a good conference call, and that'll be that. And don't expect, a massive move.
It's probably, some would call it the second weakest liquidity, trading liquidity-wise, week of the year next to just the Christmas holidays. Does it mean that we could expect even more just than the 10% that we would expect in the options market?
Yeah, I think that, look, I started my career in trading, and in August, because liquidity dries up, there's a lot more volatility that could happen with something like this. You got a lot of interns running the desk in the last couple of days.
You and I are here right now.
Yeah, we're here. But what is important to note is that actually Bank of America did some research on this. Over the last 2 years, Nvidia earnings had a pretty influential effect on the markets, not just that day, but the following 2 weeks. So it's not just like a daily event. It could carry forward for the next couple of weeks as well.
What do we think about whether or not this story around Nvidia is enough to either propel the next leg higher for the market or give you that concern that the AI...
I'll listen to his response here, but I'll explain in just a moment why in detail I'm expecting the move not to be huge in regards to Nvidia.
Perceived bubble by some could be due for a kind of correction.
It has a big effect, right? It's the bellwether for a lot of the other chip stocks, but as well for the broader technology sector. But I would caveat that that's looking at the next, call it, couple weeks, months. There is the fact that earnings are doing well for non-tech sector as well, and that's not dependent as much on Nvidia. In fact, some of the other stocks that are not tech-driven have driven the rally in the last couple of weeks.
So if you're looking at the earnings growth picture...
So the reason I'm not expecting a massive move in Nvidia outside of a shockingly bad earnings report, which is likely not happening, or shockingly great, like just the most insane beat, like, oh, we're going to do even $4 billion more than you guys think for the next quarter, right? Which I also don't think is the highest probability. Why I'm expecting such a muted reaction in this one is this is a stock in which everybody knows the story now. There's no real surprises in this story anymore. Everybody knows Nvidia's story. Everybody knows the growth rates, right? And the growth rates have gotten so ridiculous in regards to stock that it gets much harder to really have that blowout quarter in terms of the upside, right? At the same time, is the demand going to fall for Nvidia in the short term? No, that's not happening either. We know Meta, Microsoft, all these massive companies, Tesla and all these guys, they've all confirmed they're ordering as many chips as they can get their hands on for the remainder of this year, and likely it's going to push into 2025. So we know there's no end of the world situation in regards to their business model, and we also know already kind of the upside here. And so that's why I'm expecting a very muted reaction from the stock, and we're not going into this earnings at, clear all-time highs. We're also not going into this earnings with the stock prices in a very low state. If the stock price was still in the $90 range to $100 range where it was a few weeks ago, right? Remember on that Monday we had all that drama? Then I would be thinking like, oh yeah, we're probably going to make a massive move to the upside here. Don't be surprised if this one moves 15, 20% on these earnings. But given that it's already made the big move, we're back in the 120s now at this point in time, I think it's going to be very hard to get a massive move in regards to this, unless there's something that I'm not seeing that's going to be shockingly great or shockingly bad. I just don't see either of those scenarios playing out, which makes it hard to get a very substantial move.
This growth story driving the market higher. What parts are your favorites with regard to earnings growth driving upside for the market?
Yeah, no, great question. First, technology needs to hold up, right? It is such a big component of the S&P and of earnings that you can't really say earnings will be double digit without Meta and Google and Microsoft continue to perform. But there are sectors like financials, for instance, that have a couple of tailwinds going for them. One is that if rates come down, we were just talking about mortgage rates, you could see financials continue to perform even better than they have recently. You add the fact that their valuation looks attractive versus the tech sector, and momentum's going their way, right? Financials are one of the best performing sectors this year. There are other sectors that could continue to carry the rally.
With regard to the cyclical versus the less economically sensitive or defensive sectors, we've also seen folks gravitate a little bit more towards the utilities equation, the consumer staples, some of the heftier dividend payers. It seems to also click with an environment where the Fed is expected to lower interest rates systematically over the course of the next 12 to 24 months. Yeah, are defensive sectors still in play?
I think so. There's been a rotation already happening, right, from tech into sectors like that. Look, if rates come down, high dividend yielding stocks become more attractive than they used to. But that's one part of the play. There is the fact that if the economy holds up, and I believe it can, right? The data so far supports the soft landing. Some of the cyclical sectors, like financials, that do have a cyclical tilt, could perform well as well.
All right. Andres Garcia Amaya with Zoe Financial, thank you very much. We'll see you again soon.
Thank you.
So he brought up a very important point there, okay? And this could be something, a big something that's going to play out in terms of if you want to wonder what stocks are going to do really well over the next, we can call it 12 to 18 months. I'll show you the type of stocks, honestly. It's even stocks that have been such trash stocks, like a WBA. Don't be surprised if a WBA does very well the next 12 to 18 months, right? I have no position in the stock. I haven't for a long time. But I'd be shocked to not see a stock like that do very well in the next 12 to 18 months. And the reason being is all these sorts of dividend stocks, even a Wynn Resorts, right? These stocks have not been the play for a while. And the reason being is a lot of people play these sorts of stocks, whether it be a WBA, a Wynn Resorts. You could even go to like the Starbucks and the Nikes and those sorts of stocks, right? Because they're seen as their business models that are going to get through the storms, right? There's no question about that, right? But additionally, people like to go to those for yield. Well, for the past year, you haven't needed any of those stocks, really the past year and a half, because you've been able to make so much money from treasuries risk-free. So why would you take a risk in a WBA, in a Wynn Resorts, in any of these dividend stocks for that matter, right? Why would you take a risk in those if you can get an easy 5% plus on treasuries risk-free? Why would you do that, right? And so what you saw is a massive sellout of those stocks that lasted for really the past 2 years, right? No one wants a piece of those because a lot of the dividend investors all went away and they say they're going to treasuries. Well, now we're going to get the reverse cycle of that. As the Fed starts lowering rates, right, the treasury market is going to price that in. And what you're going to be able to get from either high yield savings accounts, short-term treasuries, even longer-term treasuries, it's all going to likely end up starting to come down, which then means in return, what do people start doing? They start saying, where's my yield at? I need to look for yield. Where do they look? Dividend stocks. It always comes back to dividend stocks. So next thing you know, people love dividend stocks again. Now, we have kind of a potential super cycle that could happen in dividend stocks, because if you have recession fears creep up more and more, people like to hide out in dividend stocks because they start saying, you know what, I can't make anything from regular stocks in terms of capital appreciation, but I could make some money in dividends, right? And a lot of those business models, they've been through plenty of storms in the past. A lot of these companies, they went through the great financial crisis, they went through the Rona crash, they went through all these drama periods, right? Very bad periods. So people feel comfortable being invested in those companies, even in bad times, because they've seen these companies go through bad times, right? And on top of that, you have a chase for yield. All of a sudden, you have a super cycle of demand for those sorts of stocks, which causes the stock prices to rise substantially over a 12 to 18 month span, which don't be surprised if dividend stocks go beast mode for the next 12 to 18 months. And you see a lot of these stocks a lot of these dividend stocks are sleepy stocks. You know, you never expect these stocks to double up their share price in a matter of 12 to 18 months. They're sleepy stocks. I'm telling you, you're going to see countless dividend stocks appreciate by 50%, 100%, 115% over a 12 to 18 month span, and it's going to shock people because a lot of people aren't going to see it coming. But when it happens after the fact, people are going to say, oh, we should have known that was going to happen. Like, of course, money was going to rotate to dividend stocks because it's going to come out of treasuries because they're not yielding that. And then people are looking for yield and they start looking for dividend stocks. It's what ends up happening, right? And so, you're going to see some shocking moves in regards to dividend stocks.
Earnings report of the week, maybe even of the quarter. Nvidia set to report after the bell tomorrow. Our next guest is sticking with the stock as his overall top pick into earnings. Joining us now is Morgan Stanley's Joseph Moore. Joseph, thank you for being here. So curious, obviously the Blackwell timing delays, you say that created a buying opportunity as expected, but the market looked through some of those concerns. Is there something that they could say on the call that you think the market would sit up and pay attention to in a way that is a risk to the stock?
Yeah, well, I think that the Blackwell delay is pretty minor. You know, we're going to get a little bit of volume in October. We're going to have reasonable ramp in the January quarter, which means they can kind of stick with the language that they've used, which is kind of first volume in October and a ramp in January. And importantly, the demand hasn't faltered at all. There's been a very quick pivot from customers who were looking at first stage Blackwell implementations, have just gone back to products like H200. And the fact that we're not building as many Blackwells has freed up that supply. So I think the market would be alarmed if there's any bigger delay than that, anything that takes longer to resolve than that. But clearly, you know, expectations have come up meaningfully now. 3 weeks ago, people were really worried about any potential delay in product. And I think it's become clear now that numbers are quite good. So there's an expectations issue. But the underlying demand is very good. And the execution here is very strong. I think people will, you know, look through a small delay in the initial ramp.
So let's take a peek at Nvidia's valuation going into these earnings. Alrighty, folks, so here is Nvidia's valuation, and here's what we're looking at going into these earnings. Now, I compared them here on 1000xstocks.com versus AMD and Intel specifically. And here's what we're looking at. Clearly, the forward P on Nvidia is quite substantially above AMD and Intel. We're looking at around a 53 versus a 43 and a 28 for Intel. 2-year forward P significantly above these as well. Now, first thing that's very important is, does Nvidia deserve to trade at a premium versus AMD and Intel? I would say absolutely. Why? Here's why. They've executed far better with their business model than AMD and Intel have for the last several years. So when you're talking about a company that's executing on a much higher level than other companies that are their peers, right? Like they should command at a higher multiple. Additionally, they're more well-positioned than either of those companies for the next decade, right? We know AMD's the next closest, and they're still playing catch-up. They just made an acquisition that they hope to help them position much better in this market, but it's a process. And so given that NVIDIA has been executing better, given that they're in the marketplace in a better position than anybody else, they should command higher PEs and forward PEs and those sorts of things, right? Additionally, the growth rates are obviously insane at NVIDIA, right? Clear as day, the growth rates are pretty astronomically high. So in terms of NVIDIA, I look at the stock and I don't say it's expensive. I also don't say it's cheap. And the reason I don't say it's cheap is I think there's a decent probability we could see in either 2026 or 2027, we could see revenues kind of flatline or go down. And the reason being is I think you'll see a 1 to 2 year pause, and I don't want to say pause on spending. It's not going to be a pause, right? That would mean their revenues went and crashed. You'll be a major slowdown in terms of the amount of spend. You know, last year, this year, and even into 2025, you're getting this like fever of spending, of like all the big tech companies saying we'll spend whatever it takes over this, you know, couple year span to get really up and rolling in a major way. And I think starting probably in 2026 and then into 2027, you'll see a major likely pullback, which will mean NVIDIA's revenues at that particular time will either flatline or they'll go down for a little bit there. And so that's why I wouldn't say the stock is necessarily cheap today. But you can't really say it's expensive because you know they're going to be coming through with some insane EPS over this next several quarters. So, by the way, pinned comment down there today, I'll put if you're looking to apply for access to 1000xstocks.com, as well as access to my private stock group, private wealth group, learn everything I got up here, take your game up to a much higher level. I'll put that as a pinned comment down there today. You can click on that, fill out an application. We'll see if we can get you access maybe next week.
This demand stabilization can last. Nvidia is essentially a monopoly when it comes to AI chips, and it's benefited from a lot of momentum based on that. But as you kind of look at the competitive landscape, do you see anyone anywhere close in a way that could really take aim at the pricing power that Nvidia has enjoyed for so long?
Well, look, I think there's a lot of exciting alternatives to NVIDIA in the marketplace. You know, AMD's competing merchant products. You have custom products from Broadcom and Marvell that I think all will have a nice place in the market. But I think NVIDIA's execution here has been very strong. We expect them to at least hold share in 2025. So I don't expect those opportunities to outpace NVIDIA's growth because of the performance that they're delivering with Blackwell. So to me, when this story kind of starts to decelerate, it will be much more just the overall spending patterns. You know, these numbers have gotten so big so quickly. I think that's the bigger risk. I think competitively, certainly there's a lot of alternatives out there. We evaluate everything that comes out, and there's a lot of companies that will benefit from this. But we think NVIDIA will retain this kind of 90% kind of share on AI processors into 2025.
Joseph, when you see Intel cutting 15,000 workers, was there any part of it that made you think this is a warning sign for the chip sector as a whole, or was it purely because of NVIDIA's success, which you expect to continue?
Well, I think, you know, we've seen this shift towards AI, and it's ultimately not replacing traditional microprocessors, right? We still need general purpose servers in these hyperscalers. But what it has done is it's taken some of the spending budgets away from those traditional markets. And so I think when companies in those sort of more legacy areas are having to adjust, downsize a little bit, I don't think that reflects that those markets aren't going to have a decent future. I think it's just, you know, right now we've seen all of the attention going to AI. We've actually seen some of the hyperscalers go as far as extending the depreciation terms on those traditional servers. So you're extending the life of your existing hardware to make room for AI. And I think that's made things a little bit more challenging for the Intels of the world. But I think it's not an either or proposition. I think that we continue to need processors. And over time, as we start to look at some of these power consumption issues in data centers, we actually will need to do a strategic refresh of traditional processors.
All right, next one up here. Markets in AI can continue to roll without NVIDIA. This is a big statement.
One way or another. Can the market move forward if NVIDIA doesn't? Yeah, Tyler, I think it's important for investors to keep that in mind, that the markets can continue to roll on, and the markets can continue to roll on with the AI theme in mind. If you just consider the fact that last year, Microsoft was sort of the be-all, end-all as far as the conversation around AI was concerned, and it went from being the company that we considered to be the AI leader to being one of the companies that we considered to being the leader. So Nvidia could absolutely come out, blow it out of the water with earnings, give us great guidance going into the next quarter. The shares still sell off, and I think investors have to keep in mind that that's not necessarily indicative of the broader AI story starting to slow down.
Semiconductor business is volatile. Let's just put it bluntly. I mean, it can, and the stocks, they can move up and down a lot.
Well, not only is it volatile, it's meant to be cyclical, which is, I think, another thing that investors in names like Nvidia seem to have forgotten, because we've been talking about this company and trading it similar to a lot of the growthier names that have staying power, where typically your chip stocks have about a 3-year run where things are powered. There's the upgrade cycle, right? New technologies come out that require newer, better, and different chips. And Nvidia's narrative with AI behind it has gone on for quite some time, but we're still talking about it as if, it's still early innings here. And so I think it's really important to keep in mind that we could see something like one of the hyperscalers, or a few of them, Amazon, Microsoft, Google, to name a few, to develop their own chips in-house that make them suddenly less reliant on names like Nvidia, but then also a company like an AMD, for example, their first direct competitor, to create a chip that is similarly capable of running all of those different models simultaneously for half the cost, let's say, and that suddenly changes the narrative around Nvidia. So we should keep in mind, to your point, that chips are always cyclicals, and they always have that lull that comes after the boom.
So let me push back against him for a moment here, because this talking point gets talked about so often. All these other companies are going to produce chips that compete with Nvidia, right? And I own several of these companies, Meta, Amazon, Tesla. These are some of my biggest investments, literally, and I would love it if they could all create their own chips that compete with Nvidia. That way they don't have to spend such a fortune on Nvidia chips. But to be honest, they can't. These companies are trying to create their own chips to do very specific things, but they're not competitors to Nvidia's top tier chips. Believe me, if Amazon, Meta, Tesla could all create these sorts of chips that are as high-end as Nvidia, believe me, they would not be ordering billions upon billions upon billions of dollars of these chips. And additionally, if they were even remotely close to being able to put out sorts of chips with this sort of capability, anytime soon, they would not be ordering this many chips, because they would say, we could probably start creating those within the next 6 months, 12 months, something like that. So we don't need to order all these Nvidia chips right now. They're ordering all these because there's no time soon that they're going to be anywhere remotely close to creating anything that is as high-end as Nvidia, right? And you might say, well, maybe they'll catch up. Yeah, but the problem is Nvidia keeps pushing. So by the time, let's say you're Amazon, you create a chip that's just as good as what Nvidia has in the marketplace right now. It might be 3 or 4 years from now. Well, 3 or 4 years from now, Nvidia is going to have way more advanced chips in the market than they do now. So you're constantly playing this game of catch-up. Very difficult game to play. So, hey man, I would love it if all my companies could create these chips to compete with Nvidia, but it's just not realistic. AMD's got a real chance, but they're still behind.
Wait for bated breath for Nvidia's earnings. Let's talk about rates and which stocks are likely to be, or sectors are likely to be beneficiaries of the 2 or maybe 3 rate cuts that now the markets are pricing in.
Yeah, so I think that the market has seemingly capitulated around the idea that the Russell 2000 is going to be the biggest winner the moment we get that first cut, right? Small caps, if you just think about it, are usually directly impacted by borrowing to invest in things like growth. And so if you consider maybe a third of the Russell 2000 companies are not profitable, they don't generate the kind of cash flow needed to directly invest in those operations themselves. They have to borrow to grow. It does make complete sense that the first few rate cuts are going to go directly to small caps, and that's going to be the thing to drive like a IWM, for example.
A lot of attention, Malcolm, on artificial intelligence stocks. But you like quite a few of these computer security stocks. Tell us which ones and why.
Yeah, so Tyler, I actually just put out a note making the case for why I think that mass consolidation is coming to the cybersecurity industry in 2025. And one of the big reasons for that is that there's a tailwind at the backs of these companies mandated by the Securities and Exchange Commission, right? Anytime we have these massive outages, they now have to be reported to shareholders. But separately from that, AI is also making those attacks even more sophisticated and even easier to create, which means that cybersecurity is now a non-discretionary line item in these companies' budgets. And so I expect for CrowdStrike's earnings report to show us George Kurtz during their earnings report to come out and tell us something along the lines of that outage is behind them now. They're moving on, and the rest of the cybersecurity industry to be lifted by that high tide that comes from a snapback in CrowdStrike's share price.
So I appreciate him taking a very, how would I put it? A kind of borderline controversial take there of the market can still do well even without Nvidia. What's my opinion of that? I think he's accurate. And here's why, okay? If, let's say Nvidia doesn't really do anything, it doesn't mean Meta can't do anything as far as its stock price or Amazon or those sorts of things. Maybe Nvidia doesn't come in with a blowout guidance, right? Well, then you could say, well, maybe Meta, Amazon, these sorts of companies, maybe they're going to keep their budgets in a pretty healthy place as far as CapEx goes, and they're not going to increase it substantially, right? Which some people would take that as a positive, because then they say, okay, these companies are going to have more cash in the balance sheet. These companies will have more money to do acquisitions. These companies will have more to do share buybacks, right? If they want to do share buybacks, up the dividends more, all those sorts of things. So there's a lot of various ways you could kind of look at this as, potentially a positive from kind of that angle. Now, I also don't think the market wants to see, they don't want to see Nvidia stock crash though. If Nvidia stock was to crash, when we're talking about crash, we're talking, goes down 15, 20% or something like that, that would freak the market out, I think. Nvidia is too big of a market cap not to cause problems. So as long as Nvidia stock doesn't crash, I think the market can continue to move up with or without Nvidia. Now, if Nvidia stock crashes, that's going to cause a problem. That's going to cause a bunch of fear on a lot of different fronts. All right, Dan Ives, let's hear what he has to say.
Ives joins us now. He's got his, talk all things Apple. We'll probably hit Nvidia as well if we have time.
Sure.
First, just give me your take. Actually, give me your take on the CFO change. Any concern at all?
Not really. I mean, look, Luke has been a huge part of the Apple story the last decade. But the way they do it in Cupertino, it's all grooming for the successor. And if you look at Kevin, he's really an Apple insider. I expect a pretty seamless transition here. Comes at the right time, too. If you're going to make a move like this, you do it at the beginning of the year. It just continues to be, I think, the way Apple does it. Strong bench, no worries.
All right, our viewers, no stranger to your view that we are going to get an AI-driven super cycle. You think it will begin with the introduction of this phone on September 9th?
Yeah, I mean, look, all of our chat.
Yeah, because Apple CFO's stepping down, that's no reason to sell that stock, I can tell you that much. There might be other reasons to sell the stock, but not because of the CFO transition. This has been something that's been talked about. He's going to eventually retire here very soon. It's been talked about inside circles for quite some time.
Because people will be like, oh, do you just believe it? Everything we're seeing in Asia, from a component perspective, this started off as 80 to 84 million units. That's what essentially Apple was looking for iPhone 16. Now, 90, 92 million. You start to trajectory this out, I think this is going to be a historical iPhone upgrade cycle.
You do. Potentially and that's because of your going, last time we talked to you, you were in Tokyo.
Yep.
You just told me you're going back as well very soon to Asia. Is that what this is based on?
It's two things. It's really the checks, everything we're seeing throughout Asia, and then it comes down to our analysis of the pent-up upgrade cycle. Today, we estimate about 300 million iPhones have not upgraded in 4+ years. You combine this, that's how you get what I'll call an AI-driven super cycle that starts with iPhone 16. I think this starts a historical period, and we've talked about a lot on the show. Many say, the innovation's in the rearview mirror. 25% of the world, based on our estimates, will ultimately access AI through an iPhone.
Have you said over the last couple of upgrade cycles that it will be game-changing to this extent and been a little bit wrong? I'm just trying to gauge, on that, why this one will be different.
Question. Yeah, I think the reason this is different, and there have been some nuances to some of the upgrade cycles, but I think part of how we're talking about Apple, I think on the cusp of $4 trillion market cap, is that the upgrades have actually been successful and they've gained share. The difference with this is that from an AI perspective, there's going to be hundreds of apps that users will only be able to access with Apple Intelligence, essentially on iPhone 16 or iPhone 15. You go back, if you're...
I heard people are already accessing on iPhone 14. That's word on the street. I don't know.
The iPhone 15, you will not be able to access Apple Intelligence. And that's why we continue to believe the consumer AI revolution goes through Cupertino, just like the enterprise revolution is going through Godfather of AI, Jensen, Nvidia.
So I keep saying this, I'm going to keep saying this. This next iPhone's not going to sell well because of AI. It's going to sell well because it's the biggest iPhone ever, and every single time Apple comes out with the new biggest iPhone ever, it always sells well. And it's a very simple game.
Those apps that you think are kind of a need for people, that they'll say, oh, well, I know someone who has upgraded and they're able to do X, Y, Z. Now I feel the need to do X, Y, Z. What is the stickiness of that? Of that product.
Yeah, it's great, and it's all about developers. I mean, developers, that's the lifeblood of Apple. And right now, with Apple Intelligence, with iOS 18, they're going to be building hundreds of apps that are going to be AI-driven, generative AI. So it's not just about open AI, how a typical user will be accessing their actual iPhone, whether it's health, fitness, a lot of functions that we see consumers. When we talk about AI, this is really going to be the device. This is the start of the consumer AI revolution. And many will say, well, what about Samsung? What about others?
Yeah. Listen, I'm going to start a conversation we're going to have to continue on your next time here because we've got to wrap up. But what about the idea that as AI moves to the edge, moves to the actual device, right? I don't need apps anymore at all. I'm just going to be able to talk to it, and it's going to do whatever I need it to do, and therefore Apple becomes sort of superfluous.
Yeah. And that's a great point. Apple's one step ahead because they recognize that ultimately the hearts and lungs of their ecosystem are the apps. So they'll provide the building blocks. That's what Cook talked about WWDC. Developers will provide the actual functionality. And that's the success of Apple, and that's why Apple continues to play chess and others play checkers.
Yeah, so whenever you have all these sorts of changes, you got to understand people are very quick to run to the scary parts of that, right? So his thing about you don't need apps, you're going to be able to just talk to your iPhone, blah, 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 right? Okay, that's going to cause massive fear about what that means for the future of Apple's revenues, what it means for their services revenues. From our understanding, Google cuts Apple tens of billions of dollars of checks every year, from our understanding, right? And so if Google's disrupted in any substantial way, that disrupts Apple's as well, right? That is substantially because they make so much money off Google. And so I think that's an important thing to understand is people are going to be running numbers and they'll be running projections like, okay, if this changes this, then suddenly this causes massive disruption. This disruptions that messes up Apple's money, right? And I think it's fair to ask, is Apple willing to disrupt itself nowadays in the Tim Cook era? Steve Jobs era, yes, absolutely. Steve Jobs is always willing to disrupt Apple's business model, right? The iPhone killed the iPod. Let's just call it what it is. It happened. He was okay with that. Is Tim Cook okay with disrupting that business model in a substantial way? I don't know, because we haven't seen that yet. So we'll see how that all plays out, but that might be a time point where, maybe the iPhone could actually get disrupted by somebody else who's willing to make the changes for the future, right? Still time for investors to focus on quality. Let's focus on what is actually quality versus not.
Morgan Asset Management Chief Market Strategist. Hard not to like what we're seeing. No one wants to fight the tape, I guess. But is there anything concerning in the underlying mechanics of what you look at in the market, Gabriella, or all clear?
So I would say it's never all clear. When we think about the risks these days, it's really two-sided. The first, on the more macro front, there is very clearly a downshift happening in terms of the momentum of economic growth. Soft landing, still the base case, but as Chair Powell and the Fed members let us know last week, risks are tilted now to the downside in terms of growth. So for us, the way to implement that in portfolios is still to be risk on. We still prefer equities, corporate credit, but to remember that we shouldn't go to an extreme positioning in small caps, for example, or low quality cyclical stocks. It's still a time to focus a lot on quality. And then the other big risk is just in terms of position.
It's important to understand, all small caps could get thrown in this they're not quality conversation, right? But there's a lot of, I think, Russell 2000 type stocks, small cap type stocks that are actual quality, that are much higher quality than a lot of stocks that are, let's say, in the S&P 500. A lot of people say, I'm buying the S&P 500. Dude, there's a lot of trash in the S&P 500. I mean, a lot of trash. A lot of very bad companies that don't have much growth going for their futures and are not going to be in a great position and probably won't even be in the S&P 500 in a few years, right? And so don't automatically assume because a company has a large market cap, it's a great company. No. We talked about WBA earlier in this video, right? A dividend stock there. I mean, that used to be seen as a very quality company, and now it's a $9 stock, right? It used to be a $40 stock. And there's a long list of examples. Look at Boeing. Boeing used to be seen as, this is such a great quality stock, such a big company. Boeing has been nothing but a dumpster fire for 5+ years now. 5+ years. Let's pull up a chart on Boeing. This baby is just, I think, one of the most disappointing big stocks in a long time. Boeing. So let's take a peek here. We pull up a 5-year. A 5-year, the stock has lost over half its value in the past 5 years, Boeing. I want to back it up to a 10-year chart on this one, which would put us back to, 2014-ish, late 2014, where are we at here? So you can say somewhere around here. I mean, heck, on a 10-year, Boeing's up a whole whopping 33% in 10 years. And on a 5-year, it's down 52%. Don't assume because a company has a big market cap. Don't assume because a company's in the S&P 500 it's quality. And don't assume because a company's in the Russell 2000 it's a small cap company that's not quality. Look at the revenue. Look at where the revenue's trending. Look at where the margins are trending. Look where the net income's trending, right? And then you can start to begin to judge, is this company good quality, not good quality, those sorts of things.
Valuation, sentiment, and here we come to the more overextended parts of the market, like the Magnificent Seven, and of course the big focus ahead of Nvidia's reports tomorrow, as well as some other tech companies. We still find that sentiment and positioning towards the early winners of AI are pretty overextended. And as we saw earlier in the summer, the snapback of that enthusiasm can be painful for portfolios.
I mean, looking at big stocks is in assuming those are quality, it'd be like, to give a kind of an analogy about this, it'd be like if we were judging basketball players and all we had to judge off them is how tall they are, right? And so we see some really tall guy and we're like, he's quality. That's a quality basketball player there, right? He's really tall. And then we see like Steph Curry walks up and we're like, he's not quality. He's trash. He's bad quality, right? And who's actually quality? Who's not? It's the small guy, Steph Curry. He'd be seen as actually the quality. So that's where you got to dive in. You got to do a little bit of research. You got to figure out what actually is going on here. You can't just say that one's big, so therefore it's good.
We're done with our growth fears from a month ago when the VIX hit 50. That's in the past. Not going to happen again. What's going to happen next? Do you think that shakes our confidence in staying long?
So I think it's still very much something that's going to stay alive. This idea of, is the economy just downshifting or normalizing, or is this the start of something worse? And hopefully the Fed does get going, and we would prefer at a faster pace to bring rates down closer to normal, to keep the show on the road and even set us up for a better 2025.
So that's where the risk is. You're not worried about it, inflation coming back. You think they've accomplished that side of things, and now there may be a lag to all the increases we saw. So the risk is on the economy getting too weak.
I think so. And I think we would agree with Chair Powell and the Fed's assessment that really it's not like there's no inflation risk ever. I think it's going to be a feature of the next decade. Sometimes you have these inflation shocks. But cyclically, it does seem like inflation expectations are anchored again, and really we're just fighting this very idiosyncratic last two battles of auto insurance and shelter costs. So really it does seem like the momentum is really much more focused on the labor market, and next Friday, of course, is key, as well as every single Thursday, 8:30 a.m. jobless claims and the whole mosaic of jobs data that comes out. So for us, it's still base case. Growth is just normalizing, soft landing. But I do think in terms of portfolios, whereas before it was diversifying inflation shocks, we still need to do that. Plus make sure that we diversify growth shocks. And bonds finally, again, show that they can help. When we had the 8.5% sell-off of the S&P, the ag or core bonds were up 2.2%. And that's where we see a lot of investors off sides. It's investors that position in equities or they're in cash. And really the work to do and the urgent work is to actually look at intermediate bonds and set up a core fixed income allocation again.
It was interesting earlier. We heard that, 380 is where the 10-year is, and that there's nothing below 380.
If you're wondering when the VIX is going to start spiking back up again, my personal opinion on that is I think after the first rate cuts, the VIX will start spiking. And the reason being is after that first rate cut, you're going to have a lot of markets. You're going to have the bond market moving huge. You're going to have treasuries moving huge, because then it's like a question of, okay, they actually cut. How much they cut? Is it 25 or is it 50? Some people are expecting a 50. Some people are expecting a 25. So there's going to be a huge group that's wrong. Then they're going to have to make adjustments. How many times are we thinking the Fed's going to cut after that before the end of this year? What about over the next 6 months versus the next 12 months, right? And so then you're going to have a lot of volatility and things moving around, opinions changing, perspectives, right? What does the Fed say at that particular time that might lead to you to believe that they're going to cut more aggressively or less aggressively? That's going to be moving all types of different rates around. Then additionally, you go right into the election after that, which you'll see volatility likely spike during that situation, because you're going to have a lot of people saying this guy's going to win or this woman's going to win, right? A big group's going to be wrong, and then you're going to have to make adjustments for that, right? And so don't be surprised if that VIX starts to go up substantially right after the first rate cuts. That's when all of a sudden, next thing you know, and you'll get some real volatility coming in this market again. So that's my opinion.
3.25 in terms of the charts. Mm-hmm. So we're going to stay above 380. If we're not going to stay above 380, then your growth concerns are going to be what probably would get us down to much lower yield. So you figure we'll stay above 380 then?
I feel like what we've been seeing is this range around 4%, because I think the long end, less sensitive to just interest rates, more sensitive to the fiscal discussions, which are going to take up the entirety of 2025 around the expiring tax provisions and what that means for the slope of the deficit and the debt. In terms of where we see the biggest room for yields to fall, it's certainly in the short end of the curve, especially your more 2-year and below, which are very interest rate sensitive. The forward curve is telling us rates 18 months from now are probably going to be closer to 3%. So what's the sweet spot there where you can lock in income and get some capital appreciation? It's really that 5-year intermediate part of the curve. So there's no need to go to the extreme and go super long duration. But it is more than the ultra short positioning that we see a lot of investors have on the supposed fixed income side.
So we are in a bull market, and it's going to last a while in stocks.
Yeah, we generally consider that the U.S. goes through these secular bull markets. Really, we've seen that since we came out of the financial crisis. And really because the economy grows over time, earnings spectacularly grow over time in the U.S. We have a lot of conviction that companies are really, really good at coming up with amazing new goods and services to sell their end consumers and preserve margins. And this last earnings season, the last two, have been great to show that margins have stabilized and they're even improving. So secular bull markets that come with these at times cyclical sell-offs, and we've had that 8.5% correction, late July, early August, totally normal. In terms of the next bigger downturn, that's usually associated with a recession, when it comes, and that's why we want to have some of those growth diversifiers just in case, but still lean into risk, just given the positive outlook next 12, 18 months, as well as over the next few years.
Becky Quick said, I'm taking that interview off. Okay, next one up here. Expect the Fed to cut a series of 25 basis point move. Roger Ferguson.
What looks to be an impending interest rate cut is former Fed Vice Chair Roger Ferguson. Becky. He's also the former president and CEO of TIAA, a CNBC contributor, and more than a bit of a Fed whisperer. He's been telling us all along kind of what to anticipate from the Fed as we've been seeing these things, and he's been right. So, Roger, let me ask you the two questions that Steve posed on this. How far will they cut and how fast?
Thanks for having me on, Becky. So I heard what Steve said. I think they'll cut in a series of 25 basis point moves. I think he laid out some of the rationale for that. The economy is still doing very well. Unemployment has been creeping up, but I would say only creeping. And frankly, on the other side, inflation has been coming down, but it has been creeping and uneven as well. So I think wisdom of the committee will be 25 basis points. How far will they go? I think only time will tell. Because of the question that Steve posed very clearly, they aren't really sure, and no one is, of what this so-called neutral rate is. And so they want to inch along and then let the economy and the incoming data tell them if things are roughly in balance.
You think that there is pretty much unanimous?
Yeah, I don't like the 25. I like a 50 rate from the start. I like another 50 toward year end in either November or December. Get us down 100 basis points. And the thing I'm concerned with is they're going to do these little dinky 25 basis point cuts here at the beginning, which aren't going to do anything, right? Okay, so let's say they do two 25 basis point cuts before the end of the year. It does nothing, okay? Brings us down from 5.25 to 5.5 down to, 4.75 to 5, right? Does nothing. So, and then you continue kind of going down a little slope. The problem is when you move so slow like that, right? And especially when you're very elevated, you set yourself up into being way behind the curve potentially. And if you're way behind the curve, oh my gosh, like we know how that ends. We saw that in 2022, right? They were way behind and inflation got completely out of control. And we know obviously the damage that caused. It caused a lot of damage in the financial market in the short term. It caused some banks to go under. Additionally, it caused a lot of pain on the consumer, right? Between how high the Fed ended up having to raise rates. Maybe if they had went stronger right from the go, right? Maybe they didn't have to go as high as they had to go. Maybe they would have been able to stop at 4%. Like, we don't know, right? Because we can't play it out again. All we do know is they went too slow at the beginning. And that's why all of a sudden, next thing you know, they had to go 75 basis points, 75 basis points. So imagine they go too slow here again. Imagine the economy takes a bad turn over the next 6 months. And next thing you know, you get the Fed starting to panic and they're doing 75 basis point cuts. And it's like you could have got out in front of that. And I don't know, man, like I really worry about these little 25 basis point moves. Whew. Yeah, we'll see.
That they're going to cut by 25 basis points this next meeting?
I think it's probably pretty much unanimity on the committee. You know, the market will have different points of view. I think the market will be very focused on, incoming labor market data, ignoring the fact that Powell said they're not data point dependent, but data dependent. But yes, on the committee, I think 25 is probably where most people are centering their expectations for the upcoming meeting.
So when you hear from people who say, look, the economy is really starting to take a turn for the worse, the Fed needs to move quickly, they are behind the curve on this, they're not looking at the most recent data, what's your reaction?
My reaction is this is a very large economy, and there are many different sources of data, many different inputs, and this is a committee that is looking for a consensus. And so there will be some people in the committee who argue what you've just said, maybe we should move faster. There'll be some people in the committee who would say, wait a minute, inflation is still, well above our target. We are predicting that it will get there, but we're not sure. And so I think part of the dynamic here is a committee of 19 voices, trying to decide what best to do. And in that circumstance, while there be arguments on both sides, the central tendency will be more towards that 25 basis points. That'll be something for everybody. If you think the economy is weakening, we are definitely cutting. If you aren't sure how quickly things are unwrapping or unfolding in terms of inflation, then we are cutting at a moderate rate. So I think there are lots of dynamics that will lead the committee to 25 basis points, even though a few people may point to the need to try to go faster at this moment.
And that's an important point by him, and then I'll make an important point off of this. You move 25 basis points, it shows that you're uncertain, really. It shows uncertainty. you're not moving definitively enough in a direction, right? That's why I feel like 50 basis points is that perfect number. You're clearly signaling we're confident in our decision, we're lowering rates, we're not in panic mode, we're not going 75 basis points, 100 basis points, which would be full-scale panic mode, right? We're going 50 basis points. It's clear. We know where we're headed. We know where we're going, and we're making that clear to the market. We go 50, we go 50. At some point in 2025, if the data remains good as far as inflation numbers go, and you're not super happy with the economy, you go another 50. Everything's clear. 25 basis points just signals we're confused. We're just testing the waters. We don't really know. I don't like that, man. I don't think the market's going to like that either, to be honest.
The Dow hit an all-time high again yesterday. S&P has had a lot of highs this year. It certainly still seems to be the perspective of the markets that we are in for a soft landing. Is that your opinion?
I hope that's the case. And what we heard from Chair Powell is the expectation of pain that he talked about a year or two ago does not seem to be necessary now. He also said something very important, which is that the Fed is not trying to engineer a weakening of the labor market. They're trying to engineer, stability in the labor market. So all of that suggests to me the odds of a so-called soft landing, fortunately, have gone up. It's not done yet, however. Part of the question is going to be, if inflation proves to be a little sticky, will they feel the need to really try to soften the economy to get it back down to the 2%? So right now, fingers crossed on soft landing, more likely than not. But Powell himself did not declare victory. And I think that was very wise of him to wait and see before we say we definitely have achieved that elusive soft landing.
Okay, let's play a game. Let's play a game for a moment, okay? Let's say your life was dependent upon it. And you had to keep unemployment rate under 5%, which, let's call it, the soft landing happens. What would you do if you were the Federal Reserve right now? I know exactly what you would do. I know what everybody would do in this situation. You would cut rates to zero right now. Would you not? Of course you would. If your life depended on it, you would cut rates to zero. If your family's life depended upon it right now, you would say, we're cutting rates to zero right now, right? Because you wouldn't want to take the risk. So the more you go below that, the more risk you're taking toward not having the soft landing and eventually having unemployment rate go to 5% plus, 6% plus, 7%, 8%, 9%, 10%, right? So sometimes it puts you in a good kind of frame of thought to think in those terms because you think differently. And you say, what can I do to make sure this absolutely doesn't happen? That's just the truth behind it, right? Now, you might cause inflation to spike if you cut rates to zero today, but you could deal with that down the road, right? At least you wouldn't have to worry about 5, 6, 7% unemployment, and then you're not being here anymore. So let that sink in for a moment there, because I think that's an important point.
Soft landing, the whole idea of it. I guess you had been a little skeptical of it happening. You sound like you're more of a believer now, too?
I'm definitely more of a believer in that. I was skeptical, as with many people at the very beginning of this, because inflation pressures, moved very quickly. There was a risk it didn't happen. Fortunately, that would be built in. Some of the reasons to still be concerned about inflation is that some of it is built into the housing sector. And that is a reflection not of how loose or tight monetary policy is, but of some long-standing imbalances there where, the number of housing starts has been, coming down a bit. It may be drifting back up. And so in that market, the way to get balance is to keep prices high and maybe even have them increase. So some of the challenge around inflation may be really hard to drive out, which indicates potentially that we still have a little risk for the soft landing. But yes, my odds of soft landing have gone up, as have most people, and I hope that we are correct in that assessment, because it would be wonderful for the economy and wonderful for the reputation of the Fed.
Alrighty. I appreciate y'all joining me. As always, I have nothing to add there at the end. If you're looking to access 1000xstocks.com, my private stock group, private wealth group, I'll put the pinned comment down there for that. You can click on that, fill out an application, and maybe we can get you access to all of that maybe next week so you can become a much better investor than where you're at here today. Much love and have a great day.